Welcome back to the deep dive. We're here to sift through, well, really a mountain of corporate updates, filings, and trades from the last 24 hours or so, and pull out what really matters for you.
Yeah, it was definitely a packed cycle, lots of Q3 earnings, some pretty dramatic institutional moves. So our mission today, let's cut through the noise.
Yeah.
We need to figure out what's really happening with PayPal's strategy shift.
Right.
And understand how Wayfair pulled off that surprising profit jump. Plus, those M&A rumors and streaming, that's big stuff.
Okay, let's unpack this then, because looking across everything, I'm seeing like two really clear trends pushing against each other right now. First, you've got legacy fintech suddenly acting mature, signaling maybe the end of just pure growth.
In a second.
The consumer and home sector, just delivering efficiency and profit that, well, frankly, I don't think many people saw coming.
That's a great way to frame it. It really feels like the market is forcing companies to, show their cards. And you're seeing this sharp split between the ones finding new ways to grow and others maybe having to accept lower, more sustainable valuations.
So let's start right there with fintech. The biggest story has to be PayPal, PYPL. They dropped their Q3 earnings, and I mean, the results looked massive on the surface. GAAP EPS, $1.30. That's up 32% year over year.
It is. And non-GAAP EPS hit $1.34, up 12%.
Okay, but wait. Why the difference there?
Well, that's exactly where this sort of maturity nuance comes in, right? GAAP includes things like one-time items, stock compensation, stuff that can swing wildly.
Ah, good.
Non-GAAP, which management usually points to, showed more, let's say, moderate growth. Still good, but $8.4 billion in revenue wasn't really the headline grabber.
Was the other stuff. Raising the 2025 guidance, and the big one, approving the company's first ever dividend payment.
That dividend, yeah, that's a genuine watershed moment.
Yeah.
It's management under Alex Chris, basically saying, okay, the hypergrowth stock story is evolving. Now it's about cash flow, about value.
So they've hit a ceiling on easy customer growth.
That's likely part of it.
Yeah.
They're signaling, look, we're a mature financial utility now, and we're going to reward shareholders directly. It probably addresses some market skepticism, maybe even some activist pressure,
And Chris is trying to balance that message, talking about getting back on a growth trajectory,
Right.
pointing to partnerships with Google, OpenAI, Perplexity, trying to position PayPal for like the future of integrated commerce.
Absolutely. Trying to have it both ways, perhaps. But contrast that confidence, that maturity play with the newer players. Look at Robinhood.
Right, they're still full steam ahead on the growth playbook.
Totally. Aggressively pushing product.
Yeah.
They just launched Robinhood Legend, this new browser-based trading platform, very next-gen focus.
And analysts seem to be buying it. CICC initiated coverage with an outperform rating, slapped a $155 price target on it. That suggests the market thinks there's room beyond just crypto and simple trades.
Plus, you saw ARK Invest buying up a big chunk of Hood shares. That's a strong institutional nod.
So maturity at PayPal, aggression at Robinhood, but not all fintech is getting that institutional love, right?
Definitely not. Take Block, SQ. We saw JCSD Capital dump its entire stake in Q3. That's, what, about $2.7 million? Gone.
Wow. That's a pretty sharp rejection. What's the read-through there?
Well, you have to think it's concerns over slowing growth in Cash App, maybe pressure for the kind of profitability PayPal is now actually delivering.
Meanwhile, Affirm, AFRM, Truist Securities kept its buy rating, so it's not doom across the board.
No. But the takeaway for you listening right now is pretty clear. Fintech is really segmenting. PYPL is pivoting to value, HOD is all about product expansion, and some in the middle, like Q, are facing some serious investor questions.
Okay, that separation makes sense in digital payments. But let's shift gears to that other trend you mentioned, the unexpected efficiency in the home goods market. That sector really did deliver some surprises.
Yeah, if fintech was the pivot story, the home sector is, like you said, pure unexpected efficiency. This is where it gets really interesting. Let's start with Wayfair.
W. They absolutely crushed estimates. Adjusted EPS came in at $0.70. The consensus was, what, $0.44?
Exactly. And total net revenue hit $3.1 billion, also beating the $3.01 billion estimate.
But the profitability, that's the stunner.
That's the key insight, yeah. The net loss wasn't just trimmed, it was slashed. From $364 million a year ago down to $99 million. This wasn't just luck.
Yeah.
No, this feels like sustained, hard-won operational discipline kicking in. Aggressive cost cuts, much tighter inventory management, pulling back on maybe excessive promotions.
So they're proving they can actually sell furniture profitably. The street must love that narrative.
Desperately wanted to hear it. Though it is worth noting on the filing side, CEO Niraj Shah's recent stock sale popped up in a Form 144 filing.
Form 144. That signals an insider intends to sell restricted stock sometime in the next year, right?
Correct. So you see a massive earnings beat, then a Form 144. Sometimes makes investors pause for just a second. It's just a data point to keep an eye on.
Okay. So putting Wayfair's strengths in perspective, what about the other players? Zillow, Z.
Zillow's focus seems less on just listings now and more on owning the entire user journey, right?
Yeah.
They launched that big messaging feature buyers, co-buyers, chatting, sharing listings in the app.
Plus the integrated pre-approval checks, closing dashboards, trying to wrap everything up.
Exactly, trying to build that end-to-end platform. And then you have the commercial real estate giant, CoStar, CSGP.
They beat on revenue, $833.6 million. But actually missed slightly on adjusted EPS, $0.23 versus $0.30 expected.
A slight miss there, yeah. But importantly, they raised their annual revenue and adjusted EBITDA guidance.
Okay, so underlying strength despite the EPS miss. What's driving that?
Seems largely driven by their residential side, specifically Homes.com. They added 7,000 new members in Q3. That shows, even with higher mortgage rates, the underlying demand and the move to digital tools is still really resilient.
Got it. And quick heads up for listeners, volatility watch in this sector. Rocket Companies, RKT, reports earnings October 30th. And AppFolio, APPF, saw an institutional seller, Alliance Asset Management, lightening their position.
Right. Okay, let's pivot again. Completely different world.
Yeah.
High-stakes entertainment and media. This is where market turmoil and strategic pressure feel most visible right now.
And the biggest piece of news here has to be the Warner Bros. Discovery, WBD rumor.
Huge. Multiple outlets reporting that WBD management is actually considering selling the entire company.
Wow, a sale of the whole thing. That just puts a massive question mark over their whole strategy, doesn't it? Given the debt load, the merger integration costs.
It really does. It suggests that maybe the path to profitability just through organic streaming growth is proving, well, much harder than they thought.
The streaming model itself just feels structurally challenged, all that debt, the crazy content spending.
Exactly. This rumor feels like a direct consequence of that pain. And meanwhile, the competition is fierce. Look at Comcast CMCSA, their NBC Universal unit just poached Taylor Sheridan.
The Yellowstone creator from Paramount Plus.
The very same. That's the new game in media, isn't it? When balance sheets are tight and M&A is tough.
Who can't buy the assets, so you buy the hit maker.
Precisely. Talent poaching like this is almost the new M&A. It's cheaper, faster, and you hope it guarantees that pipeline of must-watch content platforms need to keep subscribers hooked.
Speaking of drama, Netflix, nflx is still feeling the aftershocks of their earnings. Stock dropped, what, 12%?
Yeah, and analysts are now really digging into the valuation. The focus is intensely on international revenue. Seems like that's viewed as the main, maybe only, real engine for future subscriber growth.
And we should mention Roku, R-O-K-U. They've got earnings coming October 30th, too. KeyBank kept a buy rating on them ahead of that.
Right. The whole sector just feels like it's in flux. That WBD rumor is hanging over everything, plus this scramble for unique content.
Okay, moving on to health and lifestyle. Here we're seeing some signals, maybe some speed bumps, even in hot areas like health tech.
We are. Take Hims&Hers, HMS. TD Cowen kept a hold rating, and they specifically called out two concerns.
Which were?
One, potentially softening demand for those composite GLP-1 weight loss drugs, and two, growth moderating in their core Hims.com business.
Wait, GLP-1 demand softening. That space felt like it was unstoppable just a few months ago. Why the potential slowdown?
Well, it was a huge momentum trade, right? But maybe caution is setting in. You've got the big brand names like Ozempic and Wegovy really taking hold. Plus, maybe more regulatory scrutiny around compounded versions and just general market saturation. If Hims&Hers can't really differentiate their digital service in that crowded field, that growth story could fade pretty fast.
But it's not all caution. Institutional confidence seems solid elsewhere in health IT. The Teacher Retirement System of Texas reported buying more shares in Viva Systems, VEEV.
Right. And don't forget, we have key earnings coming today after the bell that could give us a read on medical aesthetics. Bausch Health Companies, BHC, is reporting Q3.
Consensus is looking for EPS around 1.06, revenue $2.63 billion. What's the key thing to watch there?
Definitely the performance of Solta Medical, their aesthetic device unit. It's seen as a good proxy for consumer spending on elective medical treatments. Tells you something about discretionary health spending.
Okay. And tying consumer focus back to the broader market. Just a quick housekeeping note, CarMax KMX, used car retailer, got bumped down.
Yeah, downgraded from the S&P 500 to the S&P Small Cap 600. It's based on market cap rules.
Is that just a technicality, or does it mean something more?
Well, the market cap decline that triggered the move definitely reflects business pressure. Used car margins are getting squeezed hard right now.
Higher interest rates on loans? Tighter consumer budgets?
Both. Exactly. So the downgrade itself forces passive index funds to sell, which just adds more pressure to a stock that's already struggling. It's not just a footnote.
Got it. Okay, let's wrap things up with a look at broader consumer trends, specifically apparel and beverages. Athletic wear is showing a really interesting contrast.
It really is. You had Lululemon, L-U-L-U, up almost 2%, based on some undisclosed Bloomberg report about athletic apparel suggests positive news or catalysts ahead.
But Nike, NKE, was down slightly, and analysts are debating, is the stock down like 62% from its high finally a buy?
Right. It highlights how the market right now seems to be favoring those premium, maybe high-margin niche players like Lululemon over the sort of general sportswear giants like Nike.
Then in beverages, similar divergence.
Kind of. You saw institutional confidence in PepsiCo, PDPO. Sterling Investment Management took a new $3 million position. But over at Coca-Cola, KO, an EVP sold over 13,000 shares, reported on a Form 4.
A new investor buying in versus an insider trimming. Classic divergence to watch.
And one more quick note. BellRing Brands, BRBR. Bernstein reaffirmed their outperform rating. And importantly, they settled multiple class action lawsuits tied to their joint juice product. Getting those legal issues cleared up is definitely a positive.
Okay, but the really critical event in the consumer space today happens after the close. Starbucks, SBUX, reports Q4 and full year 2025 results.
That's the big one for today. It'll give us a really fresh read on global consumer sentiment, especially how things are holding up in key markets like China.
So let's try to synthesize all this. If we pull out the crucial nuggets for you, the listener, what stands out?
I think it's threefold. One, PayPal's decisive shift the dividend, the move towards value. Two, Wayfair's pretty stunning operational turnaround leading to actual profit.
Yeah.
And three, the potential existential shakeup in media signaled by that WBD rumor.
And what's really fascinating across all of this is how clearly the market seems to be drawing lines, rewarding companies like PayPal and Wayfair that show they've regained maybe structural momentum or efficiency.
Right.
Versus penalizing those facing strategic headwinds or slowdowns, like we discussed with Hims or the used car market reflected in KMX's downgrade. It feels like the market's patience for just promises of future growth, especially on high debt, is wearing thin. Execution today is getting rewarded.
That's a great point. And maybe the thread connecting it all is risk, right? PYPL is actively de-risking its image with that dividend. Meanwhile, WBD's massive debt load means the entire company is now viewed as, well, the ultimate takeover risk.
Okay, that leads perfectly into our final provocative thought for you to chew on today. If PayPal's stability pivot is what the market craves, and that WBD sale rumor represents the kind of instability and debt-fueled crisis the market fears, which force do you think will have the bigger ripple effect across all sectors in the next quarter? Stability seeking or crisis management? Which type of move are you expecting to see more CEOs make?
Something to think about.
That's your deep dive for today. We'll catch you on the next cycle.